Let's bring in top bank analyst Mike Mayo of Wells Fargo ahead of all of that. And it doesn't seem like there's, much expectation that we're going to hear a lot of greatness out of these numbers. Is there, Mike?
Second quarter bank earnings, it's a battle. I term it the 3 R's, rates, recession, and regulation. The battle with higher for longer interest rates is going against banks, and that's why estimates have been going lower for almost all the large cap banks, except for JPMorgan, by the way, this year. The battle with the recession, it's still potentially to come. I think that'll be a positive story, though. I don't think you'll see too many signs of a recession from the banks. And the third battle was regulation and the new rules that are about to be put in place. And you just had the stress test, and only a few of the largest banks are buying back stock. Many of the regionals will not be doing it. So, rates, recession, regulation will be top of mind, and that leads to a fourth R, which is realism. So I expect most banks to guide for lower net interest income or interest rate-driven banking revenues just due to higher funding costs, which are taking a toll. Now, having said that, these stocks have derated by 25% over the last 3 years. And Scott, you're talking about this high stock market. The PE on the stock market was 23 years ago. It's 20 times today, and the bank PE has gone from 12 to 8. That's getting to kind of ridiculous levels, especially if we're not having a hard landing. So our top pick has been JPMorgan. Goliath is winning. The larger the bank, the more sticky the deposits, the more they're equipped for a recession, and the less regulatory changes to come. And some other of the big Goliath or GSIB names that have had regulation for a decade and won't have too much to come. The sleeper pick for the quarter here is State Street, Scott. They're what's called a trust bank or a banker's bank. And, the average stock price globally has gone up 8% in the second quarter. So that should help the likes of State Street, which also, by the way, is buying back over 15% of its stock this year. State Street had a terrible first quarter. The stock was down 7% after that day. So we just think that State Street has the chance to at least be better than the first quarter. And even if it's not good, they'll be in the market, I think, buying back their stock. And then there's Citigroup, which is proving that it's not your parent Citibank. This is a company that is outperforming the regional banks. It's outperforming many of the European banks. It's outperforming certainly Credit Suisse. It won't be perfect. I don't think their guidance was very good for expenses or capital markets. But what will look good is that they're showing resiliency despite some of these headwinds that have hit the industry. And I do think we're in the 7th inning of these downward earnings revisions. And I know a lot of investors say once the negative revisions are done, and again, I think you're going to get more over the next week and a half, then more people will be ready to step in. And as you can see, people are already buying these banks before the earnings.
All right. Well, you gave me one answer with your entire view off one question, so we're going to leave it there. Mike, thank you. That's Mike Mayo.